So good morning, everybody. Welcome to the conference, which is also, as you know, the kind of follow-up to the event yesterday. So I have the pleasure to introduce Moritz Schularick as a keynote speaker. So yesterday we had a discussion on the fact that financial crises are infrequent events, and this makes the life of a financial stability kind of regulator quite miserable, because you always have to cry wolf all the time, and things never happen, unfortunately so. So I think Moritz is very well known to us and to any kind of financial stability conference as one key kind of person in the literature on the macro financial history. So the idea here is to have a lot of data from history and to overcome the infrequency of crisis through kind of the sheer power of a large data set. And so this has been a key contribution to what we know about financial crisis and how to predict and prevent financial crisis. So I think, Moritz, I also associate you with the view that what matters for predicting crisis is credit more than interest rates. But I think now, if I understand correctly, you also kind of share the more recent kind of spin to this story that it's also the U-shaped interest rate that is also associated with kind of credit bubbles. So the interest rates, matter after all. But then, if this is the case, then, perhaps the question is why it didn't happen this time, because of course this time was a perfect example of that. So we had very low interest rates over a very long period, and a very quick tightening, and at least in Europe so far, and knocking wood, and no financial instability was observed. Although we had some episodes in the US and Switzerland, of course. So I would be also to hear your views on that as well. But I mean, I see that you have a presentation, so feel free to cover the material you wish to cover. So I would suggest that if you can speak around 40-45 minutes. And then we get a bit of Q&A from the audience, if that's okay for you.
Yes, that's totally fine. I hope you can hear me well in the conference room.
Yeah, I think reasonably well, yeah.
Yeah, okay, great. Thank you so much, and thanks for the very kind introduction. And while I don't have a paper or like a talk today about the role of interest rates, I'm very happy to talk about it. As you might know, we have a paper on low or expansionary loose monetary policy, if you will, and the risk it poses for financial stability. And I have a PhD student as well on the job market who looks at the funding risk and in relation to interest rate and monetary policy decisions. So I'm happy to talk about this maybe in the Q&A. But I do want to present or give a talk that is based on a paper that we call Large Banks and Financial Crisis, which is joint work with Matt and Caspar. And I thought this was a good way to start this day, because what this paper does, it is an attempt to do what we're all interested in, namely understanding the causes of banking crisis and how we can prevent them. There is a focus on macro and microprudential policy. This work is different in the sense that prior empirical work has typically used cross-country data over long time spans, aggregate cross-country data. If you think about a lot of the macroprudential literature, the early one, it's been sort of looking at macroprudential measures across countries across time, and our credit work has also been based on a lot of takeaway with the takeaways coming from these macro data sets, and then obviously then there's been a lot of work and fantastic work using granular micro level data. But these micro level data typically, if you have loan level, bank level data, works on the horizon of on a short time horizon. We typically have these data sets only for the past decade or 2 decades, depending on which country you look at. And so we have this very micro level insights on, say the role of capital in the 2008 crisis, or maybe funding liquidity in more recent years. But there is this sort of, in the whole literature, there's this little bit of this juxtaposition between sort of the big picture stuff, which comes out of long run macro debt work on credit booms and cycles and crises, and the very detailed, well, I guess better and well identified micro stuff that comes out of shorter samples and more detailed levels. So, and what we do in this paper, and it's been a multi-year project, is to join these two literatures for the first time and do both at the same time. So we've done, I mean, with Casper and Matt and a little army of RAs, in the past years, we have brought together a historical data set covering the balance sheets of most, I wouldn't say all, but virtually all commercial banks in 17 advanced economies in the last 150 years. So we have close to 12,000 unique banks. The data are mostly transcribed from archival sources. And this allows us then in this detail to investigate banking industry structure, bank level dynamics before, during, and after financial crisis, and also allows us to look at sort of the size distribution in greater detail than this was possible before. So, in other words, what we can do is we can a little bit live in the best of both worlds. Look at balance sheet dynamics on the banking side on the micro level, given we don't have loan level data, but with bank level balance sheet data, and look at pre-crisis risk-taking, crisis dynamics, deposit flows. We can look at failure rates of different types of banks, the reorganization of the banking sector in the aftermath of crises, the role of government interventions in the above. And we can do all of this not just like for one crisis in one country, or one incident in one country, or like 2008, one type of crisis across countries, but we can do this really in the long run with, as you know, probably like around 100 or 100 plus incidents of really systemic financial instability. So the two broad research questions that we look at in this work is what type of banks tend to drive credit booms and crises. So when I mentioned at the beginning macro and macroprudential sort of attempts, and micro and macro financial also research strategies, this is really a paper trying a little bit, at least as good as we can do this, to combine both perspectives. And actually, I think there will be a surprising message at the end, and I think one that has big implications for the way we think about crisis prevention, macroprudential policy. We'll also ask if we can explain the different survival rates of large banks after crises. Are there size advantages? Are there government interventions? I'll come back to this. So the size of banks, as in other parts of the literature, will play an important role. So what are key findings? The first is in the title of the paper. It's the survival of the biggest, namely the fact that over history in these last 150 years across basically the OECD world, the OECD didn't exist in the 19th century, but it's that country sample, including Japan and some sort of non-European, non-Northern American economies. Large banks will be defined for the rest of my talk as the top 5 by assets. They rarely exit or fail in crisis. In fact, and this is why we call it survival of the biggest, the market shares of large banks tend to grow in crises, so they become even more dominant after. It's, I think, something that, you know, anecdotally, many of you will have noted in 2008, for example, that in many countries this led to a further concentration of banking systems. We can show that this is not a one-off, but in fact, in the very long run, these trends in crises are present. Second point is that large banks tend to take more risk in the crisis run-up and perform worse ex post. So this connects the post-crisis performance to what happens during the crisis performance to what happens after. So if you want a shortcut for this finding, it's the large banks that tend to get us into trouble because they take more risk in the run-up, in the period going into the crisis, They perform worse ex post, judged by stock market returns, losses, etc. But they grow. Yeah? So we see during the crisis, larger bank stock declines, larger bank level credit contractions. So the large banks are really driving the credit cycle, driving the performance of the credit going in, coming out. But they tend to consolidate their market share. They're sort of rewarded for more risk taking by growing even more dominant in the process. The reasons for large banks' higher survival rates, despite their worst performance, are, and we show this in the paper, that regulators are substantially more likely to rescue top 5 banks on the verge of failure. And we show that, and I'll show you this, that this can account for most of the differential survival rate of large banks. Large banks have a more stable funding structure in crisis. This could be a more fundamental, more economic reason why they have more stability. And in the current version of the paper, at least, I will not be able to tell these two apart. Obviously, the funding advantage, the stability of the deposit base of large banks during crisis might have to do with the fact that depositors expect government interventions. It might also have to do with some fundamental situation where these banks are better in managing risk. I'll come back. I can tell you a little bit about this later on. But overall, the picture that emerges from 150 years, 12,000 banks, 120 crises, a lot of these individual bank balance sheet data on a yearly basis, is that the financial crisis risk is driven by large banks. Large banks tend to take bigger risk before the crisis, have larger losses in the crisis, but still grow their market share. And it has to do something with, because of higher survival rates, and those, at least to a significant degree, have to do with the stability of the funding base. Last point I'm going to make quickly, which is a very old debate that I think we can answer on the basis of this new data set, namely that the question whether concentration begets stability. People often talk about Canada in this context, that Canada, with its almost like very concentrated, large bank dominated system, didn't have a crisis for a long time. So we can test this now more comprehensively with these long run micro data. And as a matter of fact, we do not find any evidence that more concentrated banking systems are safer. This is a null result, and there is a lot that you will hopefully also say in the Q&A that this needs more work and more refinement. I'm with you. But we find that the crisis probability is basically unaffected by the concentration. But conditional on crises happening, more concentrated banking systems tend to have worse macroeconomic outcomes. So crises become costly. Okay, so that's going to be the talk in a nutshell. I'm going to give you an idea about these data sets that we've transcribed, which we obviously will make available. I can just tell you, many of you have worked with microdata. It's a very different ball game than working with macro data. There's a lot of individual idiosyncrasies and cleaning up to do. We gather information on all entries and exit in our database. So we have new entries of banks, we have M&As, we have spin-offs, we have failures. So we track each individual bank. And we also collected stock prices for the largest 20 banks around banking crisis. So we can say something about, at least in the perspective of the stock market, the equity market, how the stock performance, the risk premium, the equity risk premium evolve around these crisis windows. We don't have that for the whole sample for all years. I think that's something that we want to do at some point, but we have it for the largest banks. So key definitions are: large bank are the top 5 by assets. Banking crises are defined by credit crunches. So what we do, this is, I think, important up front. We say a crisis is when we have a contraction of of lending measured by aggregate bank credit to GDP. We do have very similar results, and we can use that as well, imposing sort of exogenously the JST crises or using the Baron-Berners-Young dating with the equity prices. That's a choice that doesn't seem to matter. We thought this was the most sort of, I say data-driven definition, where we just say like, okay, something is wrong in the banking system when we see these large contractions in lending. And large bank-dominated systems, last point, will be systems where the asset share of the top 5 bank exceeds 50%. Yeah? So these are, whenever I use any of these terms, this is what I refer to. On the crisis definition I already mentioned, this is robust to using the other big existing definitions that are out there. Here are historical balance sheet examples. Here is the Crédit Lyonnais. When you see on the left-hand side a Canadian bank, with all its assets. Don't ask me. This is really the sort of the raw data coming from the annual reports of these individual banks, and you know, a lot of scanning and transcribing and cleaning up went into building this data set. Some summary statistics. We have, on average, 39 banks per country year. This is, so, you know, a very comprehensive. I don't think we can say it's the universe of banks, because there's some privately held that we don't have all the information, but it's a large share. If you look at this ratio of the assets we cover relative to our previous work, where we use sort of the banking sector aggregates, we're roughly around 80% of the total balance sheet size of the banking systems that we have here. Average bank age, 41 years, etc. You see these statistics. I'm not going to go into detail, but we are quite proud of the data work we did here. Some historical trends before I go into the analysis. So first of all, what you see here is the bank assets to GDP of the top 5 banks versus all other banks. The top 5 are the largest 5, and it's their assets over GDP. On the left-hand side is for all countries. It's just a very simple average. On the right-hand side, it's for the US. Basic insight, I think, is pretty clear. That we have seen a tremendous concentration of banks across countries. That's also true for the US. If you look at the right-hand side, it's still on a relative scale. Banking sector concentration is maybe a little bit less pronounced in the US than in European and other countries. But no question, since the broadly speaking 1980s. Across the world, we have entered a new phase of high banking sector concentration. You can also see, I mean, there's some interesting work that Casper and co-authors have done with Uran in Chicago and others on a long-term concentration in industry in general. There is a trend, and you can see here that increase in concentration. That's true also for other industries, but it's particularly pronounced in banking in the last 30, 40 years. Another stylized fact that I think many of you have a hunch, but that is nice to have it quantified, is the persistence of large banks. So what this shows you are the 10-year transition probabilities. So basically, the probability that a bank stays the largest bank in a country, or stays within the 5 largest banks, and these probabilities are very, very high. So large banks are highly persistent. If you are a large bank today, the probability that you're a large bank tomorrow is even staying at the top is close to 50%. So there is there's very little sort of dynamic inter-industry dynamic in terms of rank sizes over time. Here's an example from Germany. We are all in Germany today. The top one bank in 1910 was Deutsche Bank, 1996 was Deutsche Bank, 2010 is Deutsche Bank. The top, and even if you look at the top 2, the Diskonto Gesellschaft disappeared, but partly was integrated into the others. So there's a high degree, even if you look at a very long time frame, of stability and persistence here. It's higher. This is now comparing to Casper's other work on non-financials. The persistence of banks is much higher also than the persistence of non-financials. So the percent of top 5 firms from, let's take it 1910 on the left-hand side, that remain in the top 5 in 2020 is about 50%. So if you have a bank that was in the of the top 5 banks in 1910, about 50% today are still in the top 5 banks in any given country. If you come closer, 1970, we go up to 60, similar for the top 20. And if you look at the non-financials, these probabilities are typically less than half, except maybe for the last very far right column in recent years. Okay, first starlight fact is the survival of the biggest. There is stylized a big fact. This is here the top 5 banks, the failure rates during crises. So now we zoom in on failure rates of large banks during normal times and during crisis windows, and sort this by the position of the bank in the national bank size distribution. So on the left-hand side, rank 1 to 5 are the 5 largest banks, then 6 to 20, 21 to 100. So what do you see? A is during normal times, failure rates are low, especially for the big banks, and that's also true. For crisis times. If you look at all exits on the right, and then exits and failures rise in as you go through the smaller size banks. If you look at the right hand side at all exits, you see that during normal times. So this includes M&A. This includes other, not just bank failures, but just disappearance. The probability is much higher overall, but you see roughly 1% or so. But you also see that there's barely any difference for large banks between normal times and crisis times, whereas these probabilities the difference gets larger for smaller banks, generally speaking. But big stylized fact here is the top 5 banks have much lower failure rates than all others. If we do just a simple failure regression to highlight this fact, then the top 5 are significantly less likely to fall or exit, and you can look at control for all kind for crisis, country fixed effects, etc. It's a very strong stylized effect emerging from the data set that large banks have lower failure rates. Next point that I think is relevant, and I think those of you who have done work on the recent crises will have a similar impression, is that the top 5 asset shares increase around crises. So large banks tend to grow their balance sheet, grow their size during crisis times relative to the other banks. So this is the change in percentage point in the asset share of top 5 banks, and relative to the rest, the non-top 5s, the asset share rises by roughly 5, let's call it 5 percentage points or so. So, depending on how you think about a market size increase of 5 percentage points, given that we talk about trillions and trillions of euros and dollars, I would say these are quite large effects that you get these shifts towards concentration during crisis. Reflection of this is, if you look at all these crises in history and you look at the number of banks in each individual country in these crisis windows, you see that the number of banks here changes significantly. So the banking systems become more concentrated, both through the top 5 gaining asset share and banks exiting just in numbers. Around a 10% reduction in the number of banks across countries. So obviously this differs a lot between crises. So that was step number one. In terms of looking at large banks during crises, something looks quite special. Number two is that top 5 banks are not more prudent around crises. So they fail less often. They get larger share of the market. The smaller banks disappear. But what we argue here is that it's not that they're more prudent around crises. So if anything, it's the opposite. Relative to other banks, the large banks take more risk. How do we prove that? Well, they increase their loan growth at a faster rate. They decrease equity to asset ratios more. They increase non-core liabilities to asset ratios more, and they decrease safe assets to asset ratios more. So this is, sort of looking at the, if you will, at the elephant from different sides, and it's more risk taking in terms of more loan growth, sharper reduction in capital ratios. Sharper increase in non-core liabilities, so in wholesale market funding and sort of non-traditional, non-deposit funding, and in a stronger decrease in safe assets. These are the things we can do with our balance sheet data. Obviously, we would like to look at the loan composition and things like that, but there is a limit as to what we can do here. Second, top 5 banks have worse stock declines and credit contractions during crisis. So if you take this as an indicator of risk taking, the market punishes them more, and their credit contracts more. And these risk-taking differentials that we find here, so once the crisis hits, and these risk-taking differentials are magnified in large bank-dominated systems. So when the asset share of top 5 banks is greater than 50%, all of these things get stronger. And I'll tell you why the market share of top 5 banks grows in crises, even if credit contracts more. This is because there's a lot of non-organic growth, i.e. they take up the balance sheet growth through mergers, and large banks sort of unorganically through M&A soak up a business of smaller banks. So if you look at the top 5 banks' contribution to credit cycles around banking crisis, you can just decompose this into the large banks' contribution and the small banks' contribution. It's a very simple decomposition. And the 2 reasons why large banks' contribution to the aggregate boom can be large is because the share of large banks in the economy is big, or because the growth rate of large banks, of the lending of large banks is bigger than the growth rate of small banks. And it turns out that the top 5 banks comprise roughly 75% of the aggregate credit boom in the run-up to financial crises. On the left-hand side is pre-45, on the right-hand side is post-45. So if you're more interested in the recent period, look at the right-hand side, and you get the idea. The orange bars is the contribution of the large banks to the change in the loans to GDP ratio in the period leading to crises. And then the contraction. You see on both sides of the sort of crisis window, the biggest contribution in terms of the loan growth comes from the large banks, and then also on the right-hand side of the crisis window, virtually all of the bust in lending is accounted for by the large banks. So what do we have here? We have the top 5 banks' contribution. This is the distribution that I measured before. And I guess unsurprisingly, given the concentration trends that I just showed you, the contribution of large banks, of the top 5 banks to the credit cycle has grown strongly over time. Yeah, so overall, the contribution was around 0.3. If you do this decompositions now basically 2/3, or close to even a little bit more probably by now, of the credit dynamics over the cycle come from large banks. And I don't want to tell you this until the end, but maybe I don't do a cliffhanger with you, and I just tell you a big message, I think, for the policy side from this paper is. I think you can tell already from my repetitive use of the word top 5 banks, large banks, is that a lot of the phenomena that we've discussed from a macro point of view, in terms of macroprudential, in terms of credit cycle, in terms of financial stability risk, is macro-pru, or macro-pru is very close to micro-pru of the large banks. So it's really about the large large institutions that, and maybe that's one of the key, or the key message of what I'm presenting here, is really the large institutions that drive financial stability risk. And you can look at them from a macro perspective, you look at them from a micro perspective, but there is a way where macro-pru merges into micro-pru of the large institutions. If you look at the individual countries, you'll see that in very concentrated systems, Sweden, Canada, is really all about the large banks, 80%, and others it's a little lower, but I spare you the details. The credit growth here in the run-up to banking crisis, this is what I mentioned earlier. You see the top 5 banks are more dominant. There's this interaction with large bank dominated systems. You see these stronger effects of loan growth going into the crisis, and the bigger role of loan growth going into the crisis of the large banks in more concentrated systems. But if you just go through the first row, the top 5, you see there is acquisition loan growth is high, total loan growth is high, and significantly high, and raw loan growth, I mean, it's a little bit higher. That's the uncoded. Maybe ignore this for a second. But you see it's not so much about the organic loan growth. It's really that large banks grow their balance sheet during crisis because of acquisitions, mergers and acquisitions. All these trends, and that's the interaction in row 2 and 3, all these trends become stronger in large bank dominated systems. So the more concentrated the banking system is, the more important the stronger these effects become, that large banks grow in crises, have stronger growth going into it, and grow in size. I'm going to be quick because I've told you the big story, and I don't think there's much new here, and there's also nothing that is like totally that goes beyond these conditional associations. Again, top 5 banks, this is equity to assets, so this is the capital ratio, if you will, non-risk adjusted, obviously. So leverage ratio, if you want to call it that, is lower for the top 5 banks, and in the run-up. So the change in the equity to the capital ratio, but also the level going into the crisis. The large banks, I think, stand out significantly as being less well capitalized and decreasing the equity more. On the right-hand side, non-core funding, again, both significantly higher, both in the change and in the levels going into. So if you want to think about non-core funding as the, in post-deposit insurance, if you think about non-core funding as the runnable debt in the system, that runnable debt, so the source of that, the location of that runnable short-term debt is much more pronounced in the large banks than in the small banks. Safe assets to assets. Safe assets here are essentially government bonds. You know, I agree. There's an argument whether all government bonds are safe. So take this with a grain of salt. But again, the large guys have a lower level, and especially when they are in a large bank dominated system, we don't find anything that they have safety advantage on this margin. Let me skip through this and go to the performance. So I told you that large banks, and I hope you believe me, that large banks going into the crisis take more risk, have less capital, kind of behave significantly differently, more risk-taking along various margins than the small ones. When the crisis hits, large banks perform worse, and they perform worse measured by their bank stock total return. So bank returns fall more, they contract credit more, they contract their own loan book more, but on the very right hand side, they fail less often. So the guys that account for most of the risk-taking going into the crisis are actually the institutions that then going into the crisis, although they perform worse and have all kinds of issues, credit contraction, bad stock market performance, they fail less often. Again, more pronounced the more concentrated the banking system is. Let me talk about government interventions, also with an eye on time, the last 5 minutes, and come to 2 additional points that emerge from that long run work. So what happens during financial crisis? Why are failure rates of large banks during crisis considerably lower? Well, one is that large banks have more stable funding. So we show, and this is in line with the work that Charlie Calmeres and Marcus and Stefan and others have done recently, is that for large banks, deposit outflows are less sensitive to large declines in their bank stocks. So you're going to have a bank, and I'll show you the regression in a second, a large bank where the stock price drops by 80%. So the market thinks this is not good. This is a very bad situation. But the deposit base basically sticks around. If the same happens to a small bank, you have a large decline in the bank stock of a small bank, depositors take their money out. Yeah? Why is that? I mean, that's, the failure rates are lower because the deposits are more stable. Why are deposits more stable? Well, one reason, I'm not saying it's the only one, but one reason is that regulators are substantially more likely to rescue top 5 banks that are on the verge of failure. And I think this is one of the first papers really to document this trend across history. So here's the deposit sensitivity of bank stocks to equity declines. Let's just look at the first, I know it's a lot of numbers, let's look at the first column, deposit growth. On the left-hand side, so you see if the return is the bank stock return falls by 30 to 60%. For a top 5 bank, you can have a decline of basically the stock price can fall by half, and it doesn't matter for the deposit situation. If anything, actually it's 0 or like slightly positive. You can even have 90% declines, and there is some deposit outflow, but it's about half as big only as it is for the small banks. This is the interaction term in the second row. And if you have really like a catastrophic decline, like you're almost like between 90 and 100% stock price reduction. So you go from the share price of 100 to somewhere between 1 and 10. In that case, for small banks, basically a quarter of your deposits has left or will leave. For large banks, we're talking about 12%. So again, only half as large. So there's a big difference in how depositors behave during crises, conditional on seeing these large declines in stock prices. Okay, so now comes one explanation, and it's not the only one. There might be some fundamental advantage that large banks have that makes them makes them safer. Maybe their funding base is more diverse. But we can discuss all of this, and I look forward to that. But one element for sure is what we show now, namely that when you look at banks in the top 20 of the size distribution in each country that are on the verge of failure, you find large differences in let's call it the attentiveness of governments to what's going on. So verge of failure we define as bank equity declines of more than 90%. So these are banks where the equity market where equity holders think, I want to get out, this is no longer worth much. Then we go to primary sources in the financial history literature on individual crises to code the fate of these institutions. Could be failure or other exit, saved from failure by the government or arranged merger, or creditor losses. Here is an example. Citibank was number 1 in November 2008. They got a systemic risk exception, 300 billion in troubled asset guarantees, equity injection of 20 billion. And the TARP Inspector General said the essential purpose of the deal was to assure the world that the government was not going to let Citigroup fail. Ranked number 6, Washington Mutual in 2008, goes into FDI receivership, sold to JP Morgan for a price of 1.9 billion. Most debt assumptions, unsecured senior debt obligation of the banks were not assumed, and these debt holders were wiped out. So very sort of different, it is just a different treatment depending on rank, and you get this in history too. So this is Netherlands, 1921, the Rotterdamsche Bankvereinigung is the number 2 bank, it gets rescued. Marx & Co., number 9 bank, fails. Systematically, what we find when we do this, for all the banks and all the crises in our sample, we look at top 20 banks during the crisis window that had an equity decline of more than 90%, which we call banks on the verge of failure. And then we just tabulate the probability that a large bank, the top 5 banks, that's column 1, with an equity decline of 90% in the crisis did not fail or exit. And the probability is roughly 80%. So your large bank, your share price falls by 90% or more. The probability that you as a big bank survive the crisis is 80%. If you look at why that's happening, saved by regulators from failing is 64%, and 64% of the cases that happens. And if all creditors are protected from losses, happens in 90% of the cases. So whatever the deposit stability is that large banks have, if depositors rationally know this and anticipate this, that could have contributed. But now look at the top 6 to 20 banks. So that's further down the size distribution, or further to further down the size distribution. You have the same situation. A bank share price drops by 90% or more. What's the probability that bank survives? It's 25%. It's only 1/4. How many of those get saved by regulators? 13%. And if creditors are protected from losses, okay, the difference is also large, but it's relative to 90, here it's 60%. So now assume hypothetically that regulators never did any of these interventions. Then the survival rates, actually even in this table between large and small banks, would be similar. So we have 78% minus 64, so this is 14% would have survived without government intervention, and that's pretty much the same 13% as small banks or smaller banks would have survived without government intervention. So there's a big shift in the probability of survival for large banks because of I would say an asymmetric or very specific support that comes for large banks in crisis times. Okay, I think this is convincing. I don't need to show you some regressions to. If you're a large bank, you're more likely to get rescued. There's less credit losses, and your failure rate gets cut roughly by half. Okay, last point, and then I'm also done. So this works well on time. Big question in the literature. So far, hard to address because we didn't have size distributions and concentration measures in that literature. Are large bank dominated? Are more concentrated banking systems safer? Answer is no. Same crisis probability. This is a null result. So being concentrated doesn't lower crisis probability, but the macroeconomic outcomes conditional on having a crisis get worse. I'll be short. You know this. The theoretical argument can go in both directions. More concentrated system could be more stable because you have more diversified banks, or it could accentuate moral hazard problems and lead to more risk taking. Unclear which way this goes. We find that large bank dominated systems, there's no evidence that crises are less frequent, but that contractions are deeper and growth outcomes worse. Here this is for the Baron Werner Sion. No, this is the JST and the Baron crisis coding. It doesn't matter. You can throw in all of the others, and you can play around with the indicators. You get insignificant results all around if you look for at the top 5 asset share, for example, as an indicator. Obviously, the loan growth result as a crisis predictor still stands. But then conditional on having a crisis, and this is my last chart here. So interacting the crisis with a non-large bank dominated system and a large bank dominated system, dummy gives you significantly worse macro performance. So you might say, well, it doesn't buy me protection against crises on the ex-ante side, but so there's the zero effect. Concentration doesn't really help. Maybe because these effects cancel out, more moral hazard versus more diversification. But when things go bad, the macro effects are much larger. I show this here, but I think the coefficients don't play a role. You can do this with decade fixed effects with different crisis conditions. It remains very strong in the data. That's the end of my talk. The conclusions are, I think, if you will, the most provocative that I can throw at you is let's just focus on the large banks. This is where macro-pru and micro-pru come together. It's the large banks that drive the credit cycle. It's the large banks that take more risks before crises, and there is a very severe sort of government intervention, political economy problem at the heart of our financial systems that have gotten worse in recent decades with growing concentrations. Government interventions in crises lead to lower failure rates, to higher rescue, and to even more concentration. So we are stuck in the system where regulators and central banks and government agencies arguably have to run ever faster just to stand still. Well, because these guys get ever bigger, and the urgency to save them when things go wrong grows. So a lot of what we call macro-pru is the shortcut is to call it a micro-pru of the large banks. And overall, however, our historical work does not suggest that we live in a safer world when banks are so concentrated, as there's no evidence that somehow the diversification benefits of centralized systems that are very concentrated outweigh other effects. So there is no prices reduction. This is all, this is all sort of very big picture evidence, conditional correlations, but doesn't seem to be anything that sticks out in terms of really large effects there. Okay, I'll leave it here. I'm very happy to talk about the role of interest rates and U-shape in the Q&A. Thank you very much for your time. I hope it was, despite my apologies again for not being there with you in person, but I hope despite the distance, this was entertaining enough on a Thursday morning. Thank you.
Thanks a lot, Moritz. This was indeed fascinating. I found it really fascinating, especially these long data sets that you have, and this also sharp conclusion that you obtain. And in terms of not you being here, I mean, knowing the state of German trains, maybe it was the safest option now. Perhaps I start. I would say, if you agree, I collect some questions, and then you take all questions together. Is that fine?
Totally, yeah.
Yeah. Okay, so perhaps I start and I go to the floor. So the two questions I would have is so you have this kind of association between stock price declines and what happens thereafter. I was wondering, I mean, should not this also be endogenous? I mean, if it really was the case that large banks are more protected, that should have been reflected already in the equity prices. So essentially, large banks should have less declines in equity prices, before the event. So how do you deal with this kind of endogeneity between what happens after and also the stock price before? And my second question indeed is if you can say something on this kind of U-shaped interest rates, also in the light as at the beginning. So what has been happening in the last couple of years? So we had this sharp rise in interest rates. What's your take of why nothing important happened, fortunately? So. Professor, let me go to the floor. Okay, so I think Philip was the first to raise his hand, but then I go around. Yeah.
Hello, thank you. Philip Hartmann, ECB. First of all, I fully agree with Livio. Typical Moritz Schularick paper, a lot of insights, great data, and conclusions that sound kind of ring right or plausible. If you remark, so first one, a small qualification on the macropru is mainly micropru of the large banks. So that may be true for the past, but not as much true for the future. No, if you see the trends in terms of market-based financing, non-bank financial intermediaries credit that is provided by non-banks, which is not part of your data. No. And second, we shouldn't forget the networks among the small banks, so which is a macropru, a systemic risk issue. My main point revolves around government involvement in banks and in large banks. So first of all, first question is simply, how did you treat public banks in your data? And how do you treat the problem of public banks? They're really important historically for some of the banking systems you have in your study. And then, more importantly, maybe more recently relevant, the less banks you have and the more few large banks you have, the greater that, and I'm making here the Martin Helwig a little bit, I apologize for that, but the more you will have good offices, good or bad offices between governments and the small number of banks. Yeah. So some of your results could, maybe not the run-up, but in the crisis, for example, the greater risk-taking, the higher credit, and so on. So I wondered whether this could have something to do with the government being involved, for example, in a crisis, to have the governments influencing the large banks to provide more credit when everybody else's credit tanks. So do you have data about the more informal or the other than public ownership in your data that would allow you to check how the degree of involvement of the governments in the banks would influence their behavior, particularly in a crisis? Thank you.
Thank you, Philip. I mean, I think we'll have several questions, so I encourage you to be a bit rapid in asking the questions. So first Ernest and then Angela. And the microphone is coming, I hope. Yeah. Here.
Thank you very much for this brilliant paper, very insightful. Two short questions. One is maybe just a clarification from you. Top 5 banks contribute to credit cycles, not surprisingly, given their high market share. My question is, but is their contribution over proportional beyond their market share? Second question is more policy question. How do your results square with the EU's quest for an EU banking union, which also implies more cross-border mergers of large banks and M&As, which creates even larger banks at the European level?
Thank you. Angela now.
Hi, Moritz. This is Angela Maddaloni from the ECB. Thank you very much. Very interesting talk. Two very brief questions. One relates to what Philip was saying. I wonder if you have a feeling how much some of the result and maybe the conclusion that you're making depends on how you define banking crisis. Basically, you define it as like a credit crunch, no? And so I'm thinking, well, first of all, given that credit maybe now is going to be granted more also from non-banks, how much this could affect your result, but also in the past, if you have a sense, what is the weight on that? And my second question is about what you're saying about the fact that you think that large banks have like a more stable source of funding that, you know, makes them more resilient in crisis in a way. And this is maybe partly due to the fact that regulators are more likely to save them and so on. I was thinking, how much of this do the banks internalize? So, I mean, just to tell you, I mean, we know that we have some evidence that, for example, when supervision was brought at the euro area level, some banks basically wanted to escape, let's say, the SSM supervision. So would go a bit in the other direction. They didn't want to be regulated as large banks. Thank you.
Thank you, Angela. Other questions? So one there and then Marcus. Maciej.
Thank you. Maciej Grodzicki, European Central Bank. So a lot of the regulatory reform after the global financial crisis has actually recognized that features of large banks that you're emphasizing today. And we've put in place instruments such as capital buffers for more systemic banks, such as risk-based, more tighter supervision for these banks, such as TLAC and MREL requirements. So I'm wondering, how would these results look if we had these instruments for 150 years? Had you considered doing some kind of counterfactual? And do you think there are any gaps in the framework that still remain to be filled to make larger banks safer? Thank you.
Thank you, Maciej. You know, because we are colleagues, I was thinking exactly the same as you were, you know, so very consistent. Marcus?
Yeah, Marcus Behn from the ECB also. So thank you very much for the very interesting presentation. I had a very brief question on how to square the result that the credit contraction around crisis is driven by large banks with the fact that there's also an increase in the banking sector concentration. So is it that large banks are then loading off on some other types of assets, or that smaller banks are increasing their share elsewhere? So that if you have any evidence on that, that would also be interesting.
So thanks for these excellent comments. I think there's a lot to discuss, and I'm very happy to do that. In terms of the equity returns, I'll be brief. So what essentially we were looking for measures that give us an idea about the risk taking and the sort of the quality of the balance sheet and of the large banks. And yes, there's clearly endogeneity concerns, but sort of the fact that the large banks have very steep equity declines as well, for us is at least like an indicator that the balance sheet quality, at least in the eyes of the market, is not particularly great. On the U-shaped interest rate, I think there's a lot of interesting work. I think what is clear, I think the two lines of the literature are that both on the micro, but now we have a paper also on the macro level, extended periods of loose or a low, expansionary monetary policy, how measured relative to R star or some equilibrium rate, it triggers credit booms, asset price, or contributes to asset price booms, credit booms, and hence factors that we associate with financial stability. There's no, and I've presented this paper at the ECB last year, so I think there's a big question about how to look at how to think about sort of the welfare. You want some of the, you lose monetary policy for a reason, and you get welfare gains from that versus the cost of the crisis. I think that's that. And the U shape is, I think, the second line of the literature where we understand that rising interest rates typically expose banking systems to stress. There's a nice Maximilian Grimm, a student from Bonn, who's also on the market this year, has a very nice paper basically showing that the deposit channel of monetary policy. So this is the Drexler et al. Idea about you raise policy rates and deposits flow out because banks don't adjust the deposit rates one for one. That this has implications for financial stability, because what do banks do when the deposits leave? They rely more on non-core funding. So the very deposit channel of monetary policy leads to higher interest rates, leads to deposit outflows, leads banks to substitute funding into a more short-term runnable debt, and the funding structure becomes much more fragile. So I think there are lots of links. Why hasn't it crashed? I think, I guess partly because we've done better regulation. Partly we had many crashes in the US last year that were certainly related to high interest rates. And I guess last but not least, the concerns on the asset side are just not there. And I think a lot of the recent literature says in the end, the solvency or the asset quality side is quite dominant for crisis dynamics. And I guess so far we don't see that much on that side. Philip, excellent question. It might be different going forward, hopefully at some point also in Europe, and we become less bank dependent. The networks between the small banks, I guess it's sort of the Silicon Valley Bank case, etc., where you worry about the ripple-on effects, and maybe these with more network, more interconnected financial institutions, maybe this is no longer as true as it was in the past. That basically the big banks only are mainly the source of risk. On the public bank situation, no, these are all private banks, so we don't have the policy banks in here. I mean, now tell me about Sparkassen and things like that. They are, in the case of Denmark, for example, they're in and they have like maybe a semi-public function. I don't think that our big results are driven by that. There was a question about growth rates, loan growth rates. I think it was very good question. So organic loan growth is lower, they contract more, but large banks have higher aggregate balance sheet growth and grow market size because they take over some of the small banks, and sort of that's how they consolidate market share as well. Small banks exit and the large banks take over some of that business, but it's not organic growth there. On the organic side, they contract more. This is also Marcus' question. I think I've answered both in one go. Angela, yes. I mean, this is robust to different crisis definitions. I mean, maybe let me, in the interest of time, combine this with the last answer. I think the focus that we've put on regulation recently on specific risk buffers for large banks and interconnected banks makes total sense in the light of this paper. There's no way we can say, like, wouldn't we have had the Great Depression with higher risk buffers for large banks or something? But I think it's something that has emerged out of the last crisis, and that is really borne out by these very long run data in that we study here. I leave it here. Sorry if I couldn't answer everything, but I think you have a busy day and shouldn't keep you for too long.
Thank you, Moritz, also for the positive conclusion that the regulators are right, which is we don't hear very often. So thanks so much. It was very fascinating and really interesting. We need to look at your paper also more carefully, but it's really fascinating. Thanks so much for being with us.